We have Fitch saying that, it's because of the new growth model, rising economic uncertainties. I mean, these are not new issues.
Sounds pretty similar to me as what we heard from Moody's when it cut its credit outlook for China back in December. I'll just run you through a couple of these things that Fitch is citing here, saying, yes, there are increasing risks to China's public finance outlook, citing the fact that China is contending with more uncertain economic prospects as it sort of runs through this transition model. As we know, the property sector is deep in crisis, not contributing nearly as much to gross domestic product as it used to. China's really trying to, sort of pivot toward these new productive forces it's been citing for quite a while now on tech, EVs, renewables, all that kind of stuff. It's also really citing those wide fiscal deficits and rising government debt in recent years. Again, as we know, China has been contending with significant issues related to local government debt. We're seeing a lot of those balance sheets really struggle under the weight of that as China tries to pivot and figure out a lot of these things. So again, in light of the Moody's decision just a few months ago, maybe not the biggest surprise here. China's already, sort of hit back at Fitch over this a bit here. But yes, we're still kind of getting more information on, sort of the calculus behind this decision, but does come in light of that Moody's decision just a few months ago.
As you said, China crying foul. How is it defending itself?
So ultimately, I think what China has said during previous rounds of not just that Moody's decision, but also other hits to its its economic model is that it's frequently said that it's sort of taken ways to protect its economy. It's done all of these. Its economic outlook is broadly stable. It's also pointed to the fact in the past that it's hitting growth targets year on year. I mean, look, China's economy grew around 5% in 2023. It was pretty bang on with what those growth targets were. It's targeting similar growth this year of around 5%. We'll see if it ultimately hits that. But yes, ultimately, China has long said that its economic outlook is broadly stable. It's cited, certain recoveries in different sectors, and most recently in the industrial sector. So we'll see what else they have to say about this downgrade later today.
Jill, what are the chances that the local government debt defaulting? Some say it's almost zero.
Yeah, so I think at this point, look, China's actually taken a lot of measures recently to try to shore up some issues related to local government debt. I think one of the biggest things that we've seen in terms of its sort of a sea change in strategy toward protecting its finances is that it's actually starting to shift some of the burden more toward the central government. We're seeing that in the form, for example, of it issuing a bit more sovereign debt this year to try to help support fiscal policy. We saw the announcement just about a month and a half ago at China's National People's Congress that it would be issuing ultra-long sovereign debt. Still waiting to see some of the resolution of that as that gets tipped out over the course of this year. But yes, it does seem like, look, I mean, China has long known that it's got issues with with local governments draining their coffers because, as we know, they can't sell land anymore, a key source of revenue because of the real estate crisis. So it has shifted some of that burden again toward the central government in Beijing to try to help alleviate some of those issues. And it's also just taken a lot of efforts to, sort of stress to local governments that they do need to mitigate risks from local debt. They do need to pay down those, that debt on their balance sheets, and they do need to ultimately find alternative sources of revenue to, help support fiscal funding in the years to come.